Okay, Bismillahirrahmanirrahim. Let's start with the today's session. First of all, let me introduce myself. This is Muhammad JUNAID Khalid, and I'm the course facilitator, the FR tutor, and I'll be conducting that practice to pass or prepare to pass webinar. And first of all, we'll discuss the agenda of this particular session. That what is the agenda of this particular session? The agenda of this particular session is. एक में कैमरा लगाऊं Okay, first of all, let's start with the agenda of the session. That what is the agenda of this particular session is? The agenda of this session is we are going to discuss the difficult and the challenging questions. Remember, particular papers of ACCA, the examiner issues the examiner report. Have if we just talk about the section C, so yes, for section C, there are past papers that are available on ACC website or on the practice platform. But for section A and B, there is no as such past papers. There is no past papers. But yes, what examiner does that in every half-year attempt, examiner identifies or examiner highlights the most difficult MCQs from section A and section B. Yes. From section A, the examiner identifies or highlights the OTQ, that is objective test question, and from section B, examiner identifies or highlights the most difficult OTKs. It means that the MCQs or the OTKs that were proved to be the challenging one, not for any particular country, not for some specific candidate, but for all over the world, the students or the candidates that were appearing in that particular exam. So it means in those examiner reports, the examiner will be highlighting the most challenging questions or the MCQs with respect to section A and B. Now, what my point of view is that if you want to clear your exams financial reporting paper in first attempt and with good marks, so what my viewpoint is that section A and B will help you out to clear your exams. Remember, if we just aggregate the marks of section A and B, so it's 60 marks, 30 marks for section A and 30 marks for section B. So the aggregate weightage of section A and B is 60 marks. So out of 60 marks, if you will be scoring 40 or 45 marks, so it's not that difficult to clear your exams. So which means it's proved that section A and B will help you out to clear your exams. Rest section C will help you out, will assist you to score more marks so that you can score more marks in your exams. So it means section, you have to work hard a lot on your section A and B. You cannot skip it because 60% marks, and mark my words, it's quite easy to secure 40 to 50% or 40 to 50 marks in section A and B in aggregate. It's not that difficult one. What you have to do, you have to practice a lot. If you are practicing, so hopefully you will be acing your exams. You will be acing your exams in the first attempt and with very good marks. So for that purpose, I have kept this session. In this particular session, what I'll be doing, that I'll be discussing and will be practicing. Remember, it's a prepare to pass. I will not be solving the question alone. You guys will also be participating in that particular webinar. We'll be solving the question with mutual concern. We'll be solving the question with an aggregate efforts. First of all, you will be trying the question, and once you will done it, you will solve it, or you will not be able to solve it. Then I will start the practice. I will not only solving the question, but instead I will be giving you the brief introduction of that particular accounting standard. We will not only be solving the particular question, but we will also try to recap that particular standard at its maximum. So in this particular session, I'll be discussing the challenging question. Yes, we will not only be practicing, we will also be discussing the challenging questions of previous attempts. And these questions are highlighted. I have compiled the last 6 attempts difficult questions. If you want those practice questions, I will provide you in the PDF file. You can definitely WhatsApp me. At the end of the session, I will also give you my contact number so that you can text me out and I will send you those difficult questions. Now, second thing is, the second objective or the agenda is identify the mistakes that examiner has highlighted in the last report. I will let you know, I will tell you that what was the difficult or the challenging part of that particular question and what other students made the mistakes. So we'll definitely discuss that one as well. We will definitely discuss that one as well. And in this particular session, in this quick revision, what we will do, we will have a quick revision of consolidation, these standards in all the questions that we'll be attempting. So we'll discuss the consolidation, we'll discuss the ratios, IAS 41, IFRS 16, IFRS 15, IFRS 9, IAS 21, and IAS 2. So these areas will be recapped in that particular session. We will have some practice questions. Those are related to consolidation. Few questions are related to ratios, IAS 41, IFRS 16, IFRS 15. And I told you, we will not only be solving the question. Instead, what we'll be doing, we will also I would say that discuss this standard as well, that how that particular standard will be solved, or how that particular question or similar questions will be solved. So we will definitely be discussing all of these areas. Okay, so let's start with this session. And first of all, we will have a first question that is from the March-June 2024 examiner report. So first we will discuss the examiner report questions that is related to March-June 2024, and then we will move on. And then we'll move on to the September-December 2023. And these are the best questions, I would say this one. That you will realize that the question seems to be very simple, but it will not the case. It will not be the case. There will always be some complications, and we'll discuss it out. So first question that we have on the screen, and that question is related to IFRS 16. So that question is related to IFRS 16. So first of all, I would request you all to please solve the question. First of all, you guys try this question and try to solve the question and try to fetch out the answer. Please first you try, and then we'll discuss that question, that how to solve it, and we'll definitely give you the overall insight of that particular question. So please try this question. Please try this question. First of all, you guys try this question, and then I will try to solve this one. Okay, the first answer that came to us, that is the total lease liability is 110. Okay, we'll see that one. We'll see that one. Anyone else, please? Okay, another answer is 155. Nice, very good. Anyone else, please? Please remember this session is the prepare to pass. It means that you have to prepare yourself to pass your exams, and you can't pass your exams unless you will prepare, you will practice. Okay, 160. Another answer is 160. Okay, great. Okay, let's try to solve this question, that what it is the requirement of this particular question. Let's read out the question first. On 1st May 2005, the directors of Hoop Company entered a 5-year lease for the equipment. It means that is we are talking about the IFRS 16. We all know that in IFRS 16, there are two types of leases. Number one, the operating and the finance lease. And remember, most of the questions that are being tested in your exams is related to finance lease. Now, there is a lease of 5 years term, the present value of the future lease payment. Now, the first thing that examiner made the confusion for the students, that here it is written that it's the present value of future lease payment. Now, listen to me very carefully. Present value of future lease payment means that it is the present value of the future lease payment, which means the first rental is not included over here. Remember, please do remember that if I'm talking about the present value of the future lease payment, it means that if I'm making the 5 rental of it, for example, that is the first, second, third, fourth, and then fifth. So these are the 5 rentals that I'll be making it out. So if I'm telling that this is the present value of future lease payment, which means in which the first rental is not included. That is basically the meaning of future lease payment. But now listen to me very carefully that the present value of the future lease payment was 185,000 at 1st of May 2005. Okay, perfect. But the second half of this sentence, has clarified it that this 1,85,000 is prior to the first payment. Yes, here it is. This is something that examiner has made it, and this is because of this one, most of the candidates were unable to answer the question correctly, and this is something that you guys have done as well. I think the 1 or 2 answers were correctly marked. There are only 1 or 2 answers that I've received right now were correctly marked. Otherwise, rest of the answers are incorrect. So here it says that 1,85,000. First of all, it is stated that these are the future lease payment. But in the second part, it states that this is something that is prior to the first payment. This is something prior to the first payment, which means that this is not the future lease payment. This is something 1,85,000 in which all of these lease payments are included. In this 1,85,000, all of these lease payments are included. Yes, please mark my words. Listen to me very carefully. If we will read out this first part of the statement, that it is the present value of future lease payment. Yes, I accept this one. That this is the future lease payment, which means the first rental is not included. But once the second part of this statement, I read it out, that it is something that is prior to the first payment, which means that in this 1,85,000, all the 5 rentals are included. Now the terms of the agreement requires the annual installment of 45,000 to be paid in advance. Yes, and we all know that in case of IFRS 16 leases, there are 2 situations. Number 1, the arrears and the advance. Here we are talking about the case in advance. It means the rental will be paid on the first day of the inception lease. It means the rental will be paid on the first day of the lease arrangement, and subsequently every year the rental will be paid in advance. So it is the advance case, and these commence on 1st May 2005. The implicit rate is 11%. Now what is the requirement? What are the possible requirements that the examiner might ask you? Number 1, what will be the amount of depreciation expense? What will be the amount of finance cost to be charged to P&L? What is the amount of current liability? What is the amount of long-term liability? And what is the amount of total liability that should be reported in a statement of financial position? Here the requirement is that what is the total lease liability that we need to calculate at the end of 30th April 2006, which means at the end of the first accounting period. Now, how we are going to solve this question? First of all, you need to remember this is an advance case. Second thing, that this is not the future lease payment. It is basically the present value of all lease payment. Although it's written over there that it is the present value of future lease payment, because of the second phrase that I've read it out, that it is prior to the first payment, that shows, that indicates that it is basically not the future lease payment, it is basically the present value of all lease payment. Now, how we are going to solve this question? First of all, we'll make a column that is the date on which the payment is made, or we can call it as the year. Second column that we will have is the rental. The third column that we have is the interest, or we can call it as a finance cost. The third column that we will have is the principal payment. and the last one is going to be the balance column. Remember, these columns you can definitely modify as per your understanding. But first, we are going to account for the year that is 2006, and the rental on 1st May. First of all, we are going to write down the 1st May 2005. At the inception of the lease, we were having a lease liability of 1,85,000, and remember, this is the total lease liability that we have. And on the very first day, that is on 1st of May 2005, on the 1st of May 2005, the rental was paid for $45,000. The rental was paid $45,000. And once the rental was paid $45,000, remember, if this is the advanced case, let me make a timeline for you guys. If this is the 1,85,000 is the lease liability, and we are making a rental, we are paying a rental on the very first day, that is 45,000. Remember, the liability was not outstanding throughout the year. It was not due throughout the year. That is the first day. So it means if there is no outstanding liability and the rental we are paying it out, so it means there will be no interest element. So far, I haven't utilized the liability. So far, the liability was not due throughout the year. So far, the liability was not outstanding throughout the year. So if I paid the rental on the very first day, so it means the whole amount will be deducted. The whole amount will be deducted. The whole amount will be deducted from the principal value, because there is no interest element. There is no interest element. So whole amount will be deducted. So it means that 45,000 will be deducted from the principal amount. So no interest will be calculated. One more thing that I want to bring into your knowledge. So remember that the answer that is required in thousands. So always remember, I'm giving you the trick to solve the question. If the answer is required in thousands, so my recommendation is that you try to solve the questions in thousands. Don't try to put the values in complete figures, in complete values. Don't try to do that one. Try to put the values in thousands. Try to make all the calculations in thousands, so that it will be easy for you to understand. It will be easy for you to calculate the answer. So it means there is no interest element in this rental. In this particular rental, there is no interest element. All the value or the amount will be deducted from the principal amount, which means 45 will be deducted. So it means that the lease liability was 1,85,000. That is 185 was the balance, out of which 45 is paid for the principal. So now the remaining lease liability is 140,000. So now the remaining lease liability is 1,40,000. Let me repeat the situation. This is 1,85,000 is the total lease liability. It's a total lease liability. It's a total lease liability. And out of these total lease liability, 45,000, the principal amount was paid, and the remaining lease liability was 1,40,000. This is something at the inception of the lease, that is on 1st May 2005. 1st May 2005. Because on the first day, that is on 1st May 2005, 1,85,000 was the liability, and out of which 45,000 is paid. So the remaining lease liability is 1,40,000 on the 1st May 2005. Now, for the whole accounting period, there was no activity performed. Even at the end of the year, no activity was performed. Yes, another rental was paid on the 1st May 2006. But so far, if we are at the end of the accounting period, that is 31st May 2005. On 31st of May 2005. Now, what is the liability element? What is the liability element? Now, listen to me very carefully. Listen to me very carefully. That 1,45,000 is the outstanding liability throughout the year. Yes. there is an outstanding liability throughout the year. It's an outstanding liability throughout the year, 1,40,000, which was not paid at the end of the accounting period, which means this 1,40,000 is the liability. This 1,40,000 is the liability which is to be paid in the next accounting period, which means that 1,40,000 is not yet paid. This 1,40,000 is not yet paid. It means that is something that you have to pay in the next accounting period. One more thing, if the liability was outstanding throughout the year, which means the interest will be applied. And remember, you have not paid anything at the end of the year. Yes, you will pay, but you will pay in the next accounting period on the very first day of the next accounting period. But so far, as we speak, that on 31st May 2005, there is no another payment, there is no further payment. So it means at 31st May 2005, the liability is 1,40,000 that you have to pay. Plus, in addition to that one, there is another liability of the interest. And the interest liability, the rate of interest that is over here is 11%. So the 11% interest will also be calculated. 11% interest will also be calculated on that 1,40,000, that is 140, which means 15. Which means 15. If I just remove 3 zeros from here, so which means that 15 is going to be the interest which is outstanding. Why? Because if the liability was outstanding throughout the year, so the interest will be applied on that particular obligation or the outstanding liability. So interest is about 15 that is outstanding for the particular liability. So the total liability that is going to be is 155. 140 is the principal liability and 15 is basically the interest liability, which means total outstanding liability, the lease liability is 155. Total outstanding liability is 155. And remember, if you are typing on the software, so there is no need to type 155,000. No. Why? Because 3 zeros are already present over here. So you just need to type 155. Now, how? For example, let me continue with that table. Remember, we are not here to just solve the question. We are here to learn many things. Obviously, on the very 1st of May 2006, that is at the start of the next accounting period, I'll be paying 45,000 a rental. Now, will there be an interest element? Yes. Why? Because 1,40,000 was due throughout the year. So it means if the liability is outstanding throughout the year, so there will be an interest element, and the interest element was 15. So out of 45, if 15 is the interest element, always remember every rental will have two payments. The first is the interest, and the remaining or the balancing is going to be the principal amount, which means 30 will be paid for the principal amount. Now the outstanding liability is going to be 110. Outstanding liability is going to be 110. Why? Because out of 140, if 30 of the principal amount is paid, so the remaining liability is going to be 110,000. 110,000 is going to be the outstanding liability. Now, although we have calculated the answer for 1,55,000, but one more thing, let's try to understand this one. If I ask you that what is going to be the current liability, what is going to be the current liability, and what amount there will be a non-current liability. So please try this one. Can anyone please give me the answer for this one? That what is going to be the current liability and what is going to be the long-term liability? What is going to be the current liability? Although this is not the requirement of this particular question, but if, for example, examiners ask you that what is the current liability? 45. Okay, 30. Nice. Very good. Anyone else? Okay, 30. Okay, let's calculate it. Let's try to calculate it. Okay, let's try to calculate it. First of all, the liability that was outstanding as 1,40,000. And remember, this was not the only liability. The total liability was 140 plus 15. Why? Because this was outstanding. This was outstanding. This was outstanding throughout the year. This was outstanding throughout the year. Now, what will happen? What will happen? That out of this, what you are going to do, you are going to pay off the rental amount. You are going to pay off the rental amount in the next 12 months. And what amount you will be paying it off? What amount you will be paying it off? That is, you will be paying the 45,000 as the rental amount. 45,000 will be paid. 45,000 you will be paying for the rental amount. That is the rental you will be paying on the very next day. For example, if I just talk about this one, 31st of May 2005, what you're saying that on the very next day, I'll be paying 45,000. I'll be paying 45,000. And what is that 45,000? Or in this 45,000, you will pay the 15,000 as the interest element which was outstanding, and remaining 30 you will be paying for the principal amount, right? So it means in the next accounting period you will be paying the 45,000. So if you will be paying the 45,000 in the very next accounting, what is current liability? An obligation that will be paid in the next 12 months. So the obligation that will be settled in the next 12 months. Oh, what's next month? In the very next day, on the very next day. So on the very next day, you will settle down, you will be paying off the obligation of 45. So 45 is going to be the current liability. In short, let me give you a tic tac for this one. In case of the advance, please mark my words. In case of the advance, always remember next rental is going to be the current liability. I repeat, in case of the advance, the next rental is going to be the current liability. Yes. Out of 155, 45 is going to be the current liability. Remaining 155 minus 45, that is 110. This is going to be the long-term liability. Here we go. Just look at the table. This is going to be the long-term or the non-current liability. So it means that 45, which means the principal plus interest. This is going to be the current liability. Why? Because this is an outstanding amount that will be paid in the next accounting period. And when? On a very next day. So this is going to be the current liability, and remaining 1,10,000 is to be considered as a long-term liability. Are you guys clear with this one? So 30 is not going to be the current liability. So the current liability is going to be 45. And the best or the easiest way to recall or to remember this one is that the next rental, in case of the advance, I'm not talking about the areas right now. In case of the advance, the next rental is going to be the current liability. Please do remember this one. Are we guys clear on this one? If there is any confusion related to that particular question, so please do let me know. Yes, Renuka, it would be 11% of 110 plus the principal amount as well. Definitely. Always remember the current liability. In case of the advance, the current liability is basically the next year rental plus the interest. Next year interest plus the principal. Or in short, if you just summarize it, so it is going to be the rental amount. The current liability is going to be the rental amount. The next rental is going to be the current liability. We are Vanisa, we are rounding it off. We are rounding it off. So if it is less than decimal 5, so we'll round it off to the backward. And remember here in the answer, it is written. Let me show you. It is written that you need the values to the nearest of. Whenever the statement is written, so we are not going to account for the decimal values like 15.4. So we are not going to account it for 0.4. We are going to round it off to the zeros. If it is more than decimal 5, like if it is 15.8, 15.9, so I must have rounded off to 16. Renuka, are you clear with this one? So whenever you want to calculate the current liability in case of the advance, so all what you have to do, you just need to look at the next rental. So next rental is going to be the current liability. And in that next rental, there will be two elements, the interest and the principal amount. Renuka, are you clear with this one? Okay, great. Let's move on towards the next question. Let's move on towards the next question. Question number 2. Question number 2. Now we have question number 2. And that question is related to IFRS 15. That question is related to IFRS 15. IFRS 15, that is revenues from customers and construction contract. Okay, Gentle Company is a company which manufactures oven and supplies them to retailers. There are no direct sales to public, which means it's a manufacturer. Which two of the following would indicate that Gentle Company should recognize the revenue at the point of delivery? First, try to recall. I told you this is not that we are not only going to solve the question, instead we are going to practice it out. We are going to learn many things in this one. First of all, that there are two ways through which the revenues can be recorded. Remember, there are 5-step model. There's a 5-step model. The first step, that is to identify the contract with customer. Second step, that is to identify the separate performance obligation. Third, that is to identify the transaction price. The fourth one, allocate the transaction price to each performance obligation. And the fifth one, that is to recognize the revenue. So here we are talking about the step 5. We are talking about the step 5, that is we are going to recognize the revenue. So in order to recognize the revenue, IFRS 15 states that there are two ways, there are two possibilities. Either the revenue will be recognized point at time or point in time, or the revenue will be recognized over the time. So there are two ways through which the revenue can be recognized. The revenue will be recognized in the point in time when the performance obligation is satisfied. When the performance obligation is satisfied. Now, what does it mean? It means, let me make it more simple and more clear to you, that it means that the risk and rewards are transferred. As simple as that. The risk and rewards are transferred. So it means if the risk and rewards are transferred, so it means the performance obligation is satisfied. The performance obligation is satisfied in point in time. And once it will be satisfied in point in time, so then the revenue will be recognized. But yes, if the revenue will be recognized over the time, which means that performance obligation will be satisfied in future. Performance obligation will be satisfied. So the revenue will be recognized when the performance obligation will be satisfied. It means the risk and reward will be transferred. Risk and reward will be transferred at some future date. will be transferred at some future date. At some future date. So revenue will be recognized at some future date. So if the performance obligation is satisfied, point in time, revenue will be recognized. Here in this question, it says that we need to identify two of the following that would indicate that the revenue should recognize at the point of delivery. It means point in time. Now let's read out the options and try to understand this one. The retailer must pay a penalty. The retailer must pay. Remember, we are the manufacturer and we are selling the goods to the retailer. So it says that retailer must pay a penalty to the rental company if it returns new oven which are in full working order. And the first statement states that we will recognize the revenue in point in time, the amount of penalty that we will receive from the retailer if the goods or ovens are returned even though they are in full working orders. It means they are not defective. One of the retailer has returned you with the goods, although it's in a working condition. So obviously the company, the manufacturer will be charging a penalty on that one. So whether if the revenue will be recognized, so the retailer must pay a penalty to the rental company if it returns the new oven which are in full condition, which are in full working order. So whether the revenue should be recognized at that point of time, please do let me know. I want your participation. And remember that what's the situation? That we have sold goods, we have sold the oven to the retailer and retailer is returning those goods. Although there is no fault, the goods are in proper working condition. So obviously manufacturer is charging a penalty. So it means the retailer will be paying that penalty to the manufacturer. So whether the manufacturer should recognize the penalty as a revenue in the point in time when the goods are returned back. So whether the revenue should be recognized or not. Please do let me know. Please do let me know. Very good, Zara. Why, Renuka? Why no? Why the penalty should not be recognized? If the goods are returned back to the manufacturer and we are charging, for example, I'm the manufacturer and the goods are returned to me. So I'll be charging the penalty amount to the retailer. So the penalty that I'll be receiving today, should that penalty amount be recorded as a revenue or not? Yes, everyone, please participate in this one. So the amount that I'll be receiving from the retailer, should the revenue be recognized or not? Yes, your point, your argument is valid. Okay, let me modify my question. Should the income be recorded or not? Yes, so consider it as a revenue. Remember, in this IFRS 15, it always gives you an idea that how to recognize the revenue income, that how to recognize it is in the broader sense. That, for example, if the manufacturer is charging, and that is something the part, it may either be the part of the business, it could be the regular course of business. That most of the retailers reject the goods or most of the retailers return those goods. So we can consider this amount of penalty as a revenue. So it means that the revenue should be recognized in the point of delivery. It means it should be recognized once the goods are returned back. So we need to identify the two correct options for this one, in which the revenue should be recognized in the point of time. So yes, once the goods will be returned back, will be delivered back, yes, the revenue of penalty will be recognized. Second statement is, the retailer has signed. For example, you have delivered the goods to the retailer and the retailer has signed proof of delivery, unconditionally accepted the delivery. Retailer said that yes, the goods are accepted. The goods are accepted. The retailer has conditionally accepted the delivery of the oven from the gentle. Now, please do let me know whether the revenue should be recognized or not. That the goods are delivered, and not only delivered, the retailer has also accepted unconditional. There is no condition behind it. The goods were accepted by the retailer. Now, whether the goods or whether the revenue should be recognized or not. Yes, please. Whether the revenue should be recognized or not. The goods are delivered and it is being accepted by the retailer. So whether the goods or the revenue should be recognized or not. Very good, Renuka. Yes, it should be recognized. It should be recognized. Why? Because very correctly answered by the Renuka that the risk and rewards are transferred. The risk and rewards are transferred. Everything is done. The goods are delivered and the retailer has accepted the goods. It means all the risk and rewards are transferred. So obviously we are going to recognize the revenue at the point in time. Okay, although we have got the answer for this question, that is A and B is the correct answer. A and B is the correct answer. But let's try to read and why. Read the option C and let's try to identify that why option C is not the correct answer. Gentle company has a statutory right to request. Statutory means it's a legal right. It means the manufacturer has the legal right to request the return of the oven in exchange for the original consideration. What do we mean by this one? That if the manufacturer has delivered the goods to the retailer, now manufacturer has the right, it has the power to return that goods. It means manufacturer may demand the return of those goods at any point of time against the original consideration, which means that the manufacturer will return that consideration to the retailer. It means the manufacturer has the right to return those goods against the original consideration without further compensating to the retailer, which means that the manufacturer may return those goods or may ask for those goods at any point of time. Please do let me know whether a revenue should be recognized or not. Whether the revenue should be recognized or not. If yes, then why? If no, then why? Yes, everyone, please participate in this one. Whether the revenue should be recognized or not. In the third option, whether the revenue should be recognized or not. Okay, great. No, because they are saying only about, right, there is no transaction occurred yet. Okay, great. One more thing, that the risk and rewards are not transferred. You just see the transaction. In this particular transaction, what it says that it may ask for the goods at any point of time, which means, Renuka, you're perfectly right that there is no transaction. Or we can say, or we can call it as that there is no risk or reward transferred. Risk and rewards are not transferred. So which means that in this point, obviously, the revenue cannot be recognized. Last one, obsolete models of the oven may be returned by the retailer. Again, that is the same point, that the goods may be returned by the owner or by the retailer. So again, if there is an option that the goods may be returned at any point of time, so again, the risk and rewards are not transferred. So obviously the revenue should not be recognized. Okay, let's move on towards the third question. And that third question is related to consolidation. This is something related to consolidation. Yes, this question is related to consolidation. Let me read out the question first, and you guys will first try it out, and then I will help you out in that particular question. Swimming company purchased 60% of the 32,000 ordinary shares of London company on 1st May 2006. So the date of acquisition is 1st May 2006, and 60% acquisition is the total number of shares of a subsidiary company is 32,000. The consideration included a share exchange of 2 shares in swimming company for every 5 shares acquired, which shows that there is a share exchange transaction. The second thing is the fair value of the swimming company shares at the date of acquisition is $15. That is the fair value of the shares at the date of acquisition of swimming, that is the parent company. Also included in the consideration is a cash payment of 157,500, which is to be paid on 1st of May 2007, which means after a year, and the cost of the interest rate is 5%. All what you have to do, what is the requirement? That you need to calculate the fair value of the consideration transfer. That's it. You're not supposed to calculate the goodwill. You're not supposed to prepare the consolidated financial position. All what you have to do, you just need to calculate the investment amount, or we can call it as the consideration amount or the consideration transfer. I would request you all to please try to solve this question first. Please try to solve this question. Try to calculate the answer for this one. Yes, please. Anyone, please? Okay, great. Mughal, very good. Angelisa, very good. Great. Okay, let's try to solve this one. Very good. A, very good. Let's try to solve this one. First of all, what we are going to do, remember that whenever we are going to calculate the amount of consideration or the investment, what we can do, that the maximum adjustments that the examiner might ask you for the calculation of investment, first of all, that is the cash consideration. The second one is the deferred consideration, as this is also tested over here. The third is the share exchange. Number one, the cash consideration, the deferred consideration, the share exchange, and the fourth one is the contingent consideration. And the other one is the loan consideration, that at times the parent company gives the cash consideration. At times the parent company promises to pay a certain amount after a certain time period. That is known as what? The deferred consideration. At times the parent company issues some of its own ordinary shares At times, the parent company will issue a certain amount against some condition, that if the certain conditions will be satisfied, so this amount will be paid. If it will not be satisfied, so this amount will be paid. So it is known as what, the contingent consideration. And at times it happens that the parent company issues the loan certificates, that is the loan consideration. So these are the tools through which the investment amount can be calculated. I have also made some summaries related to those adjustments. If anyone of you wants that one, so I will provide the summary that is related to consolidation. But right now, let's move on over here. Here it says that the parent company, the parent company issues the shares to buy the ordinary shares of a subsidiary company, which means there is a share exchange, as well as the cash payment will be made on 1st May, which means after a particular accounting period, and the discount rate or the interest rate is given, which shows that is the deferred consideration. The amount will be paid in the next year. So what we have to do, we are going to calculate the amount or the value of investment. We are going to calculate the amount or the value of investment in which there is no cash paid, in which there is the deferred consideration. Yes, there is the deferred consideration. And how we are going to calculate the deferred consideration? That is the future payment of 157,500. And always remember that 157,500 is the future payment that you have to make. We are going to calculate the present value for this one. Whenever there will be a future payment, it will be recorded at its present value. At its present value. So it means it's going to be 1.05 power 1. 1.05 power 1. We are going to calculate the present value for this one. Can anyone please calculate the present value for the deferred consideration? It's 1,57,500. It's 149. I guess it's 150 if you just round it off. It's 150 approx. So it means it's 1,50,000. So 1,50,000 is the deferred consideration. Second thing is that we have the share exchange. So share exchange, if we talk about the share exchange, so how it will be calculated? Here it says that the consideration included a share exchange of 2 shares of a parent company for every 5 shares acquired. So first of all, we need to calculate the acquired shares. The total number of shares of a subsidiary company is 32,000. Here it is given over here. And we have acquired 60% shares. Obviously, first of all, we'll be calculating that how much shares are being acquired by the parent company. So 32,000 in times 60%. So this will make 19,200. So which means 19,200 shares are acquired. And now based on this one, it says that 2 shares will be issued for every 5 shares acquired. 2 shares will be issued for every 5 shares acquired. 2 shares, which means that if we just calculate that 2 shares for every 5, it means it approximately it's 40%. That is 2 divided by 5, which means approximately 40% shares issued by the 40% shares issued by the parent company, 40% of the acquired shares. So we can write it down as 2, 4, 5, that is multiply by 2 divided by 5, or we can directly state the percentage as well. But multiply by 2 and divided by 5. So let's see how many shares are being issued by the parent company. That is 19,200 and 40% shares are acquired, which means 7680. Number of shares are issued by the subsidiary parent company. And the value of the parent company's shares at the date of acquisition was 15. So which means multiply by 15. That is 1 lakh 15,200. So 1,15,200. So the total amount of investment that would be recorded is 1,15,200 plus 1,50,000. So it's 265,200. So it's 265,200 is the correct answer. Are you guys clear on this one? Okay, let's move on towards the question number 4. And the question number 4 that is related to IAS2, that is the most easiest standard. But yes, remember in last few attempts, examiner is asking a question from the inventory that is approximately one question is being asked by the examiner. So please prepare it for the exams. Do not consider it or do not consider it as the irrelevant or very unimportant. No, it's an important standard, so you must practice it for the IAS2, that is inventory. Although it's very simple and it's quite easy to answer the question, but still do practice for the IAS2 as well. Now let's read out the question that the Procter company held 270 units of work in progress within the inventories. Remember, as per IAS2, what do we mean by inventories? Unsold raw material or the material that is not being used. Unused raw material, it's an inventory. Incompleted work in progress, incompleted work in progress, and the unsold finished goods, which means IS2 states that the raw material which has not yet been used at the end of the accounting period, it's your inventory. The working process which is not yet been completed, it's your ending inventory. And the finished goods that has not yet been sold, it's an ending inventory. Now, what is the question and what is the requirement? Let's try to understand this one. It says that the Procter company held 270 units of WIP work in progress within inventories at 31st May 2003. That is at the end of the accounting period. To date, WIP has a cost a total of 21,600. That is the cost of WIP. It is estimated that the cost to complete are $19 per unit and that the finished goods would be sold for 114 per unit. The direct selling expense or the cost are $5 per unit. It means there is an inventory, the cost of that inventory is given, the estimated selling price, and the expenses are given over here. Then what we have to do, that is to calculate the correct amount of the inventory that should be recorded or that should be valued. Now, how the situation will be considered? Now, what we have to do? Always remember, we need to record the inventory at its lower of cost or NRV. IS2 states that inventories should be recorded at the lower of cost or NRV, whichever is lower. So first of all, we need to have a comparison for the cost or NRV. For the cost or NRV, let's see that whichever is lower will be recognized as an inventory. First of all, let's try to calculate the cost. And let's try to calculate the cost per unit. And how we are going to calculate the cost per unit is 21,600 divided by 270. So the cost per unit is $80 per unit. Now, one more information is given over here that WIP has a total cost of 21,600. It is estimated that cost to complete is $19 per unit. $19 per unit. It is basically the cost to complete the product. Are we going to add this amount in the value of cost or not? Are we going to add the value in the cost or not? Okay, yes, Renuka said yes, Zara said yes, okay. No, we are not going to include that amount in the value of cost. Why? Please try to understand. Try to understand that what do we mean by cost? Cost means historical cost. And what do we mean by historical cost? The cost at which the inventory was purchased. Remember, we never account for the future cost in the value of cost. We never record. We never record the future value in the cost. Cost is something that you have incurred. The cost at which the asset was purchased. That is known as what the historical cost. So we are not going to add up anything in this one. So what is that? What was that? What was that value? That is $19 per unit. What it represents? So that represents the estimated selling expense. It means it is the estimated to cost to complete. This will be considered as an estimated selling expense. So NRV is basically the estimated selling price. And the estimated selling price is 114. 114. And the estimated selling expense is $19 per unit. That is cost to complete. And the cost to complete is $19. Furthermore, there are other selling expenses as well. And the value of the other selling expense is $5. So if you just calculate the NRV, that is 114 minus 19 minus 5. So this is going to be the $80 per unit. NRV of one unit is $90 and the cost is $80. Inventory should be recorded at the lower of cost or NRV, whichever is lower. Here the cost is lower, so we are going to calculate the inventory. So it will be multiplied by the number of units. And the number of units that we have is 270. So the cost is 21,600. And this inventory will be recognized at 21,600. That is cost. Why? Because the cost is lower. Because the cost is lower. Are we clear on this one? Always remember, we never account for the future cost. We never account for the future amount in the cost. Now, let's move on towards the OT case. Let's move on towards the OT case. This is the OT case that was tested in March, June 2024. So let's try to read out the question and then there will be 5 requirements related to that particular OT case. So we'll solve it. Now, company manufactures and sells 3D printer and related software. During the year ended 30th November 2006, company expanded its operation in another territory. The currency in the new factory is bread. That is the currency. Both companies' functional and presentation currency is dollar, which means that bread is the foreign currency and the dollar is the presentation and the functional currency. Now, to fund the expansion, company issued the following instrument at their nominal value, which means that these are issued at its nominal value. And if you see the terminologies that are being used over here, that is the convertible loan, redeemable preference shares, which means at the start of this question, the data is related to IS 21, although it's not that a difficult one, but the data is related to IS 21. In the next part, it is related to IFRS 9. That is the financial instruments. Now, the convertible loan note is given over here. That is the date of issue is 1st of December. And the redeemable preference shares is also issued. That is issued on 1st of February 2006. Now, the interest on loan notes is repayable on 30th November each year, which means that the interest repayment will be made on 30th November. Similar loan notes without the conversion right carry an interest rate of 9%, which means that is the effective rate. And if that 4% is given, that is something the coupon rate. Now the loan notes must be redeemed on 30th November 2008, which means the convertible loan note was issued, or the convertible loan note was issued on 1st December 2005. Now the loan note must be redeemed at 30th November 2008, which means the duration of the loan note is 2006, 7 and 8. That is for 3 years. So the convertible loan note is for 3 years. It's for 3 years. Either by paying the cash, or there is another option. There is another option that the investor will get the ordinary shares. So it means if you are issuing the convertible loan notes, so there are two options. Either the investor will get the amount or it will get the shares. The redeemable preference shares are redeemable at 5 years time. For convertible loan note, it's 3 years time. It's 3 years time. The redeemable preference shares are redeemable in 5 years time at a premium and have an effective rate of 10%. That is the effective rate for the redeemable preference shares. Payments are made on 31st January each year. Now the discount factors or the discount rates are given over here. Now let's see what is the requirement. We have read the whole data. In this particular question, first of all, there was IS 21 and then we have IFRS 9. In this IFRS 9, IFRS 9, the convertible loan note, coupon rate is 4% and effective rate is 9%. And in the redeemable preference shares, it's 7% is the coupon rate and 10% is the effective rate. Now let's read out the first requirement of this OT case. Which of the following statement regarding how the transaction in bread should be dealt with the Duns company's financial statements are correct? It means you need to identify which of the following is correct. Which of the following is correct? Now the first statement, that the sales and purchases should be transferred into dollars at the closing rate. It says that if we have purchased anything from outside, so we need to recognize the, we need to translate the amount. We need to translate the amount to the functional currency. Obviously, that is perfectly fine. But whether it should be translated at its closing rate, please do remember. Please try to recall it. Are we going to translate the amount at its closing rate? Closing rate means the rate at the end of the reporting date. So whether the sales and purchases will be recognized at the closing rate. Yes, please do let me know that are we going to recognize the sales and purchase transaction at the closing rate? No, we are not going to recognize the sale. And remember, the sales and purchases will always be recognized at the spot rate. The spot rate means the rate at which the transaction arises. It will never be, and always remember, even the sale or purchase or the inventory will never be retranslated, because these are non-monetary items. Only monetary items will be translated, that is the receivable and payable. Second, the closing trade receivable, the trade payables, the cash and the cash equivalent should be translated into dollars at the spot rate, at the rate of related transaction, at the date of related transaction, at the rate of, that is the most important line, at the date of the related transaction. Whether the closing receivables and payables should be translated at the closing rate. Remember, the closing receivables and payables will always be recognized. Closing receivable and payable will always be recognized at its closing rate. Yes, these will always be recognized at the closing rate because these are the assets that will be retranslated every year. So which of the following statement is correct? So statement 1 is incorrect, statement 2 is incorrect, which means option D is the right answer, that none of the information is correct. Now, question number 6. In accordance with the IFRS 9, the financial instruments under which classification should the redeemable preference shares should be measured subsequently? Remember, we are doing the OT case, and remember, in your exams as well, whenever in this OT case, there will be 5 questions. So please remember, out of 5, 2 or 3 questions are going to be the most easiest. Even you are not supposed to read the data again. You're not supposed to read the data for those 3 MCQs. But yes, there will be 2 or 1 MCQ that might tease you. So it means that in accordance with the IFRS financial instrument under which classification should the redeemable preference shares be subsequently measured? That is, we are talking about the subsequent measurement. Redeemable preference shares means we are talking about redeemable preference shares means that we are talking about the financial liability. We are issuing the redeemable preference shares. So it means it's a financial liability. And whenever we have financial liability, so always remember that there are 3 options through which the financial liability may be accounted for. Number one, the amortized cost. Number two, the fair value through P&L. And last one is the fair value through OCI. So it means if you want to make the subsequent measurement, so we have three options, either to follow the amortized cost, fair value through P&L, and the fair value through OCI. And one more thing, if we are issuing the financial liability, so please do remember that we usually classify it using the amortized cost. We usually classify it using the amortized cost. As in this question, there is no fair values are given. So it means that the redeemable preference shares will be classified using the amortized cost. Yes. Remember that whenever we are talking about the IFRS 9, the financial liability, we have three different options. We can recognize the financial liability using the amortized cost, the fair value through P&L and the OCI. But if there is no fair values are given in the question, so it means we are not going to recognize the financial liability by using the fair value through OCI or the P&L. We are going to recognize the financial liability by using the amortized cost. So in this particular example, the IFRS 9, so if you are selecting the classification, the correct classification for the redeemable preference shares is the amortized cost. One more thing that I would like to ask you, that if the examiner would have asked you that which method or which accounting treatment will be adopted for the convertible loan. So please remember that for convertible loan, we always use the split accounting. We always use the split accounting. Now question number 7. What is the initial measurement of the equity element for the convertible loan? And remember here the answers are given in the decimals, that is in millions, so we'll be working out in the millions as well. So initial measurement, at the time of initial measurement, we need the equity element for the convertible loan. Remember, whenever we are having a question for the convertible loan, first step that you need to do, the step one that you need to perform to calculate the future cash flows. So it means the convertible loan is for 3 years, 1, 2, and 3. We need the cash flows, and cash flows can be calculated by using the coupon rate. And remember, the coupon rate will always be applied on the nominal value or the par value. And the par value for the convertible loan is 5,500. And the coupon rate for the convertible loan is 4%. So let's try to calculate the cash flow for the year 1. 5,500 in times, that is 0.04, which is 220. The second, again the 220. And in the third, remember in the last year, this is going to be the 220 plus, that is 5,500, because the invested amount will be returned back. That is 5,720. Now we are going to calculate the present value of cash flows. Why? What we are doing? We are calculating the liability element first. That how much amount we have to pay in future. So in the year 1 end, you will pay 220. At the end of the year 2, you will pay 220. At the end of the year 3, you will pay 5,720. But these are the future payment. So definitely we need to calculate the present value. In order to calculate the present value, the discount factors are given over here. But remember, please do remember that whenever we are going to calculate the present value, we always use the effective rate or the market rate. So it means the discount factor that is related at to 9% will be considered. So for year 1, the discount factor is 0.917. 0.917, and the discount factor for the year 2 is 0.842, and for the third year is 0.772. Now let's calculate the present value of all future cash flows. Present value of all future cash flows, that is 220 multiplied by 0.917, that is 201.7. Then we have 220 multiplied by 0.842, that is 185.2. Then we have 5720 4415.8. Now if we just total it, that 4415.8 plus 185.2 plus 201.7. So it's something 4800. That is 4802 or 4800. 4800. What is that 4800? It is basically the present value of future cash flows, or we can call it, it is the financial liability at initial measurement. This is something, the initial measurement, the 4800. And the amount that we have received from the investor. The amount that we have received from the investor is 5,500. Is 5,500. So 5,500 minus 4,800, this will make 700. Now what is that 5,500? It is basically the proceeds. It is basically the proceeds. And what is that particular 4,800? It is basically the financial liability, that is 4,800. So which means that 700 is what? It is basically the equity component. This is basically going to be the equity component. That is going to be the equity component. That is 700. And if you want to convert in millions, so just divide it by 1000. So 700 divided by 1000. So this will make 0.7 million. 0.7 million, which means option C is the correct answer. But if I ask you that what will be the amount of initial liability, what will be the amount of financial liability that should initially be measured? So 4,800 is going to be the answer for this one. But if I ask you that what amount of interest expense to be reported, for that you will have to make the amortized cost schedule. But so far, the requirement of this question was to calculate the equity component. That is the equity element in that one. So that is 0.70 million. Are we guys clear on this one? Okay, question number 8. What amount should be recognized? Yes, please. Renuka, please. Which question are you talking about? The question number 7? In that one? Which question you're talking about, Renuka? Closing spot rate. Okay, question number 6. Yes, what's the issue? Okay, question number 5. Okay. Why option B is wrong? Okay, why point B is wrong? Okay, in the point B it says that the closing trade receivable. Let me clarify it. Account receivables or account payable at the end of the reporting date. At the end of reporting date. At the end of reporting date. Remember, the account receivable and payable at the end of the reporting date will be retranslated, and it will always be retranslated. It will always be retranslated at its closing rate. Remember, there are different rates. The one is the historic rate. The historic rate is the rate at which the asset was purchased. It means the rate of dollar at the time of purchase. This is also known as what is spot rate. It means we can call it as a spot rate of that particular, while we were purchasing the asset, the spot rate was this. So it means that is known as what the spot rate or the historic rate. The other one is the closing rate. Now, what is the difference between this one? The closing rate is basically the rate at the date of reporting. So what we do that at the end of the reporting date, we always retranslate the receivables and payable at its closing rate. At its closing rate. Rather than we are not going to retranslate it at spot rate. No. The spot rate means the historic rate. Now read the second statement over here. It says that closing receivables and payables and the cash equivalent should be translated into dollars. Yes. This is something very fine. This is something very fine, and I accept this one. And it says that it should be translated at the spot rate. Which is spot rate? The spot rate at the date the related transaction. Which means it's talking about the historic rate. No, we do not translate at the historic rate. We translate at the closing rate. Renuka, are you getting a point? Great. Now, question number 8. Question number 8. What amount should be recognized as a finance cost in respect of the redeemable preference shares for the year ended 30th November? And again, the value should be in decimals, that is in millions. Now remember, we are not talking about the convertible bond. Now this is something related to redeemable preference shares. And for redeemable preference shares, it's a financial liability. So whenever there's a financial liability, remember in most of the situation, we will be adopting the amortized cost method. We will be adopting the amortized cost method. So first, let's read the redeemable preference shares area. First, try to recall the redeemable preference share area, and then we'll try to solve it. The redeemable preference share, the amount is 2,500, and we are issuing the liability instrument, and there is no transaction cost. The first thing is, if there had been any transaction cost, we must have deducted from the amount of proceeds. Now, interest on loan notes, that is related to convertible bond. Okay, now here it is related, that paragraph is related to the redeemable preference share. The redeemable preference shares are redeemable in 5 years time. It means the duration is 5 years and definitely at a premium, and the effective rate is 10% and coupon rate is 7%. Perfectly fine. Payments are made on 31st January each year. It means that the amount of coupon rate will be paid on 31st January each year. The coupon amount will be paid on 31st January each year. And this redeemable preference shares were issued on 1st of February. Now, the thing that you need to consider, the first of all, that what is the accounting period? What is the accounting period? The accounting year end is 30th November. Okay. So there are so many dates. There are so many dates over here. Now let's try to make a timeline and try to understand that what's going on over here. The accounting period is ending on 30th November 2006. Okay. And one more thing, that is the redeemable preference shares were issued on 1st Feb 2006. It was issued on 1st Feb 2006. Okay. If it will be ending on 30th November, so definitely it will be starting from 1st of December 2005. Now, 1st of Feb 2006, the loan note was issued. Now, there is no need to work out for the whole amortized cost table. It's quite simple that on 1st Feb 2006, the loan note was issued. The preference shares were issued for $2,500 for $2,500 and the coupon rate and effective rate is also given in the question. So the coupon rate related to that redeemable shares was 7% and effective rate is 10%. 7% and 10%. Coupon rate is 7%. Coupon rate is 7%. Coupon rate is 7%. And the effective rate is 10%. Now, always remember the finance cost that will be calculated is always calculated, that will be recorded in P&L, is always calculated at its effective rate. Is always calculated at its effective rate. So what we are going to do, we are going to apply the effective rate on this particular amount, that is 10%. We are going to calculate the effective rate at its 10%. Simple as that. Remember, the coupon rate will never be charged to P&L. Coupon rate will never be charged to P&L. So effective rate is applied at 10%. But the thing is, the problem is that whether the interest will be accounted for the whole accounting period, whether the interest will be accounted for the whole accounting period, please do remember, do let me know whether the interest will be accounted, whether the interest will be accounted for the whole accounting period. No, it will not be accounted for the whole accounting period. We'll be counting from the February, that is February, March, April, May, June, July, August, September, October, November, which means that will be accounting it for 10 months. So multiply by 10 and divide it by 12. Anyone please can calculate the amount? Can anyone please calculate the amount? That is 2,500 multiply by 10%, multiply by 10 and divided by 12. It's 208, like, right? It's 208. 208. So it means the finance cost that will be charged to P&L for the year is 208. And if you want to calculate the amount in decimal, the simplest way is to divide it by 1,000. And once we will divide it by 1,000, so it will make 0.208. 0.208. It will make 0.208. And let's see the options. So 0.208, 0.20, or I think 0.208 or nearest to it's 0.21. So option C is going to be the correct answer. Are you guys clear with this one? No, it's a very easy question. It's a very easy question, I would say this one. You have been asked by your finance assistant then how to account for the transaction cost on any future issues of the financial instrument should they arise. Which of the following statement is true regarding how the transaction cost should be treated when they relate to the financial liability and classified as amortized cost? I need the answers within seconds. That if you are acting, if you have issued some liability instruments and you are using the amortized cost, So how it should be accounted? How should the transaction cost should be accounted for? How the transaction cost? Very good. Very good. Excellent. It should be deducted from the fair value. Okay. If I ask you that if we are investing, for example, if there is a financial asset and we are using the fair value through OCI, financial asset, and we are using the fair value through OCI, then how the transaction cost should be accounted for? How the transaction cost then should be accounted for? Yes, please. If there is a financial asset and we are making an investment in the equity instruments and we are using the fair value through OCI, then the transaction cost, then how the transaction cost should be? Yes, it should be added. Yes, it should be capitalized. Very good. No, it should not be deducted, Renuka. It should not be deducted then. It should be added in the value of investment. It should have been capitalized. Are you getting a point? If there's a financial asset and we are making an investment in the equity instrument and using the fair value through OCI, then the transaction cost should have been capitalized. Yes, very good. So this was the examiner reports question that was related to March, June 2024. That is a recent attempt. And now we are moving or proceeding towards the September, December 2023 examiner reports question. Here's the question. And this question we have with the IAS2, that is inventories. Now, what is the requirement and what is the data given over here? At 31st March, the company had equipment in its inventories which was manufactured to the customer's specific requirement and the cost is 3,80,000. The original selling price is 4,20,000, but new regulations means that safety measures must be added at a cost of $60,000, which means that you have manufactured the product, the cost is 3,80,000, perfectly fine, and the normal selling price is 4,20,000, but there are some rules and regulations, which means that $60,000 cost need to be incurred before the equipment may be sold. It means the seller cannot sell it unless the safety measures will be applied. So it means $60,000 need to be incurred. The customer has agreed to pay for half of these modification. Perfect. It means that 60,000, 50% will be borne by the customer, 50% will be borne by the company. Definitely company will be incurring the amount of 60,000, but the 50% will be compensated by the customer. And how it will be compensated? That the customer has agreed to pay for half of these modification costs through an increase in the overall selling price. Through an increase in the overall selling price. Now, how we need to account it for? What is the requirement? That you need to calculate that what is the value of inventories that should be reported in balance sheet. So first of all, obviously, we know that inventory should be recorded at the lower of cost or NRV. So we are going to calculate the cost and NRV, whichever is lower, then the inventory will be recorded at that particular value. Here the cost is 3,80,000. Here the cost is 3,80,000. 3,80,000 is basically the cost. 3,80,000 is basically the cost. 3,80,000 is basically the cost. Now, here the consumer is saying that I'm going to bear the cost of 30,000 and remaining it will be borne by the business. Are we going to add that 30,000 to that cost? Yes, please do let me know. Are we going to add that 30,000? Are we going to include that 30,000 in the value of or the cost of inventory? No, we are not. Please do remember. I told you earlier in the previous question, of IS2 inventory, I told you that the cost is something that we have purchased the asset. It's historical cost, the cost at which the asset was purchased. That's it. The cost at which the asset was purchased. This is known as what? The cost. You cannot account for this one. You cannot increase the cost. You cannot increase the cost by 30,000. This is something the selling expense is. That in order to sell, you have to incur that particular expense. So it means it's a selling expense. So the cost of the inventory is 3,80,000. Now what we are going to do, we are going to calculate the NRV, that is the estimated selling price, and the estimated selling price was 4,20,000, and the customer has agreed to increase the selling price with the amount of 30,000. Yes, that is the half of the safety measures. So it means now the updated selling price is going to be 4,50,000. Now we need the estimated selling expenses. The estimated selling expenses. The estimated selling expenses that we have is 60,000. The estimated selling expenses that we have is 60,000. So the NRV is going to be 390,000, I guess. 3,90,000 is going to be the NRV of that particular equipment. So the inventory should be recorded at the lower of, and the cost is lower. So it means 3,80,000 is the value at which the inventory should be reported. Yes, Muni. Very good. Now, there might be a question. Now, the error that was made by most of the students in that particular question, that examiner has identified the first mistake, that most of the student added this 30,000 in the value of inventory in the cost of inventory. This was obviously an incorrect treatment. Second mistake that most of the candidates made out, that they deducted the estimated selling expense by 30,000. This is not the correct. Let's assume that if the customer was not ready to bear the expense, if the customer was not willing to bear the expense, then if this is not the part of your question, let's say the customer has agreed, if these last two lines are not in the part of your question, these are not the part of your question, so what would have happened? What would you have done? That the cost was 3,80,000. The cost is 3,80,000, and in order to calculate the NRV, the estimated selling price was 4,20,000. And obviously, you must have deducted the whole 60,000 as an estimated selling expense. Right? So you must have deducted the whole selling expense of 60,000. So that is something you have to do over here. This is your estimated selling expense. Yes, the consumer has agreed to compensate you by increasing the sales revenue. So what we have done, we have included, or we have increased the sales revenue by 30,000. Although this is the selling expense, so this will always be deducted. So the lower amount is 3,80,000. Inventory will be recorded at its cost, that is lower amount. Are we guys clear on this one? Is there any confusion or problem in that particular question? So please do let me know. Yes, Ranika, not only you, majority of the students made this error. Majority of the students did that blunder. Okay, great. Let's move on. Let's move on to the next question. Okay, this is a question that is related to IAS 41, agriculture. Before I move on towards the agriculture, first of all, let me give you some understanding related to that IAS 41. Okay, now IS 41 states that deals with the agricultural activities, and agricultural activities means that is the biological asset and the agriculture produce. Biological asset is something that has the ability for the biological transformation. Biological transform. Remember the difference between the IS 2 and IS 41. For example, if I do have a mobile phone and I kept this mobile phone for the purpose of resale, this will be classified in under IAS2, that is inventory. But if I do have a cow and I bought that cow for the purpose of resale, again that cow is for the purpose of resale. So this cow will be considered or will be treated under the standard of IS 41, that is agriculture. Why? Because agriculture standard states that any activity that is in the management of the biological asset or for the sale of biological asset or for the sale of agriculture produce. So if there is any activity that is related to the biological asset. Now what is biological asset? An asset which has the ability for the biological transformation, which means that is increasing in terms of value, in terms of weight, in terms of quantity, in terms of quality. So it means if it is increasing, so that is known as what the biological transformation. So IS 41 states that the biological asset or the agriculture produce should be measured at its fair value less cost to sell. Yes. The biological asset, the simple rule is that you need to measure the biological asset or the agriculture produce at its fair value less cost to sell. Fair value less cost to sell. Now here the question is, the company purchased a herd of 600 bison on 1st of Feb and correctly recognized the transaction at 90,000. It means the purchase price of the bison is $90,000 for 600 commodities or units. At 30th June, the year end, the market price for the similar size of the herd was $175 per bison. All trading of bison incurs the cost of 8% plus. It means that incurs the cost. You have to incur, for example, it could either be a marketing or it could either be a agent cost. And an additional fixed charge of $1 per bison. These are basically the cost to sell. These are basically the cost to sell. It means in order to sell the bison, the estimated expenditure is 8% plus $1 per bison will be charged. Now, what is the requirement? Are we going to calculate the gain or loss, or what? Or what is the requirement? In accordance with the IS 41, what is the carrying amount of the herd of bison on 30th of June 2005? Simple as that. Simple as that. The herd of bison was purchased. It means the purchase price was 90,000. Although it's not required, but at the end of the year, the fair value, we need to measure the biological asset at its fair value less cost to sell. So the fair value was $175 per bison and it's 600. So 175 in times 600. So this will make 175 in times 600. 175 multiplied by 600. So it's 105,000. 1,05,000. Now we need to deduct the selling expenses. So the selling expense is basically 8%. So we are going to calculate the 8% of this 105,000. 1,05,000. That is 8,400 is going to be the transaction cost, or we can call it as the agent commission. And then 1% per person in addition. And there are 175 units. There are 600 units. So 600 in times $1. So this will make $600. So if I just deduct it, so 8,400 plus 600, this will make 9,000, and 1,05,000 minus 9,000. So this will make 96,000. So it means that the herd of wisdom should be recorded at $96,000. It should be recorded or recognized at $96,000. One more thing, that if I ask you that what amount of fair value gain should be recognized, fair value gain or loss, so you will say that initially it was recognized at 90,000, and now today the fair value less cost to sell is 96,000, which means the value of herd is increased by 6,000. So this will be recognized at what? The fair value gain, and will be recognized in P&L. Are we guys clear on this one? Yes, very good. Okay, let's move on towards another question. That is question number 3. And this question that we have is related to IFRS 9. Question number 3, that is related to IFRS 9. On 1st of February 2007, Kahama Company invested in the ordinary shares. First of all, highlight this one. Invested, it means it's a financial asset question. And it was invested in the equity, it means the ordinary shares. Paying 7.2 million for the shares and additional 0.8 million for the brokerage fees. The shareholding was less than 1% of the company's ordinary shares, and that has nothing to do with that one. Which means it shows, it indicates that it's not a parent and subsidiary relation, because whenever we acquire shares, so there is a possibility that there could be a parent or subsidiary relation. And when will it happen? When the acquisition is more than 50%. The other thought that might comes to your mind that it could be an associate, but it arises when it is more than 20%. So it's a hint that it is neither the subsidiary nor the associate. It is simply a trade investment that will be dealt according to IFRS 9. Okay, now, so 7.2 million is the investment and 0.8 million is incurred for the transaction cost. Company made the irrecoverable election to classify the investment. Remember, if this is given, if this terminology is given, that shows, that indicates that it is fair value through OCI. Although in subsequent line, in the another phrase, it is clarified that company is using the fair value through OCI, but it's not required. Only that terminology is quite enough. If it is written in the question that is irrevocable election is used, which means the company is using the fair value through OCI. Fair value through OCI. Okay, now one thing that we need to remember, if the question is related to financial asset, if the question is related to financial asset and investment is made in equity, there are two options, fair value through P&L and OCI. But if you are recognizing the investment using the fair value through OCI, two things that you need to account for, that you need to recall, you need to memorize. Number one, any fair value gain or loss will be recognized in OCI. Second important point is that you need to record the transaction cost. You need to capitalize the transaction cost. The transaction cost shall be capitalized. Now, at 31st December, the fair value of the investment was 8.4 million, and this was correctly accounted for. On 31st March 2008, Kahama sold the entire investment for the $8.9 million. Calculate the gain or loss on the investment to be recognized in the statement of profit and loss and other comprehensive income. Calculate the gain or loss that should be recognized in profit or loss and other comprehensive income for the year ended, and the answer should be in millions, which means you will not be typing the full value. You will not be typing, you will just be typing the values in decimal. Please try this question. Please try this question. Okay, we have different answers like 0.9 million, 0.5 million. Okay, anyone else? Okay, great. Now, the best part was, or the difficult situation was, that the student was confused. The students were confused that what the examiner is asking for. Either the examiner is asking for the P&L or OCI. So remember, the examiner is asking for the statement of profit and loss. So why the other comprehensive income is used? That is the complete name of P&L. Remember, now in the recent standard, the recent IS1, the complete name of income statement is the statement of profit and loss and other comprehensive income. Here examiner is not asking for the other comprehensive income. Examiner is asking for the P&L, that what amount that should be reported in P&L. How we are going to calculate it? Okay, let's first of all try to solve the complete question and try to meet other requirements as well. First of all, the investment that was made for 7.2 million, and in addition to that one, 0.8 million was the transaction cost, and if we are, since we are using the fair value through OCI, so the total investment value was 8 million, transaction cost will be capitalized. At the end of 31st December 2007, at 31st December to it's the requirement, in this requirement it's around 2008. 2007, the fair value of the investment was 8.9 million. 8.9 million. Sorry, it's not 8.9 million, it's 8.4 million. 8.9 is the disposal proceeds, sorry. It's 8.4 million. 8.4 million, which means the value of investment was increased by 0.4. Remember, this is the fair value gain, but this fair value gain will be recognized in other comprehensive income. This will not be recognized in P&L. This will not be recognized in P&L. This will be recognized in other comprehensive income. This will be the part of revaluation surplus or investment reserve. It will be parked in equity. Now, let's move on. Further, it states that after 31st of December, since you have accounted for the gain, now on 31st of March 2008, the entire investment was disposed. And the value of investment, the latest value of the investment was 8.4, and the sales proceed is 8.9, which means 0.5 million is the gain. And remember, this is not the fair value gain. This is basically the disposal gain. And no matter if you're using the fair value through P&L or OCI, remember the disposal gain will always be recognized in P&L. It will be directly be recorded in P&L. So the amount of gain or loss that will be recognized in a statement of profit and loss and other comprehensive income is 0.5 million, and it's not 0.9 million. Yes, if the examiner would have asked you that what amount of fair value, please listen to my words, that what amount of fair value gain or loss should have been recognized. So yes, the answer for this question should have been 0.4 million. But here the examiner is asking, what is the requirement? What is the requirement? Calculate the gain or loss. Calculate the gain or loss that should be recognized in the statement of profit and loss. That is the income statement. So in the income statement, the gain or loss that will be recognized is 0.5 million. That is the disposal gain. Are we guys clear on this one? Yes, Munib, you are right. The requirement is not that difficult, but the data that the examiner has given, because of which most of the students were unable to. Remember, at the start of the session, I told you the questions that we are doing today are the most difficult questions according to the examiner. And what I personally believe, that in most of the questions you have seen that the questions are not that difficult. It's like bit technical, or they are playing with the words, they are playing with the sentences, or they are playing with the requirements. But for you guys, it could be a motivating factor that that is the ultimate benchmark. If you guys are able to solve these questions, and not 100%, if you guys are able to solve the questions at 50% or 40%, so it means it's something that you're doing marvelous, because these are the too much difficult questions according to the examiner. It's not according to me, it's not according to you. The examiner has stated in their examiner report. Are we guys clear on this particular questions? Shall we move on? Okay, let's move on to the question number 4. And that question number 4 is related to the ratios. That is something related to the ratios. That is something related to the ratios. Now, company's operating profit margin has decreased from 15% operating profit margin. Okay, before we move on, first try to understand that what is operating profit margin. Operating profit margin. Operating profit margin, the formula to calculate the operating profit margin is profit before interest and tax, or profit from operations divided by sales multiplied by 100. Now what this formula it interprets that how much amount, or how much percentage of the profit is being earned after deducting all the operating cost. How much profit is being earned by the company after deducting all of its operating cost. That is known as what? Operating profit margin. That is known as what? Operating profit margin. Here it states that the operating profit margin has decreased from 15% to 11%, which means let's take the dummy data that 2001, 2002. In 2001, it was 15% and now it's 11%, which means the operating profit margin is decreased. And if the operating profit margin ratio is decreasing, remember there are two sides. Number one, the numerator and the denominator. If the ratio is decreasing, which means that the numerator is also decreasing, which means that the profit is decreasing, and profit could either be decreased. The reason could be the revenue is decreasing or the cost is increasing. Let me make an analysis for this one. In this particular sentence, it says that the operating profit margin is increased from 15 to 11%, which means the operating profit margin is decreased. And if it is decreased, it means that the numerator side is also decreased. And on the numerator side, there is a profit. So which means ultimately the profit is decreasing. And there are two possible ways because of which the profit might decrease. Either the revenue is decreased or the cost is increased. Now let's see what is the requirement, what is the data, what is the requirement of this question. Which two of the following could explain this decrease? What is the reason? You need to identify. The first reason that is given by the examiner, that company providers of finance, that is the loan or bank, increase the rate of interest on the loan payable. Whether this could be a reason for the decrease in operating profit margin? Yes, please. That the rate of interest or the interest expense is being increased. Rate of interest or interest expense is increased. No, this could not be the reason. Why? Because remember, the formula that we are following is the profit before interest and tax. In this profit, there is no impact of interest. So if the interest is increasing or decreasing, this will not put any effect on the operating profit margin. Because the formula that we are using is profit before interest and tax. Yes, Renuka, we don't consider finance cost in this particular ratio. Okay, so it means option A is not the correct one. Okay, following a review of non-current asset, company revised the useful lives of plant and equipment downwards, which means the useful life change in estimate. The useful life of the property, plant and equipment was reduced. Okay, let's try to evaluate this one. Let's try to evaluate this one. Okay, if the property, plant and equipment useful life is decreased, now what will happen? Let's take dummy figures for this one. Let's say 10,000 is the cost of asset and the life was 5 years, so the annual depreciation was 2,000. Now if the life is decreased, so let's say it's 4 years, now this is going to be the 2,500 depreciation, right? So it means once the useful life was decreased, so the depreciation, oh my God, the depreciation expense is increased because of the decrease in the useful life. Because of this particular change in estimate, the amount of depreciation expense will increase. And if the amount of depreciation expense will increase, obviously the profit will decrease. And if the profit will decrease, obviously the operating profit margin will also decrease. Is this the correct option? Yes, this is the correct option. It's perfectly said that the non-current asset useful life was decreased, and obviously if the useful life is decreasing, I showed you the analysis for this one. That what happened? That useful life was decreased from 5 years to 4 years. The amount of depreciation expense increased by 500. So obviously the depreciation expense will increase, the profit will reduce, and ultimately the operating profit margin will reduce. So this is the reason, and we don't want the one reason, we need two reasons. Third, company successfully negotiated the trade discount for the bulk buying raw material from its existing suppliers. Remember, the bulk discounts on purchases will directly affect the gross profit margin. Please do remember, whenever there is a point on purchases, cost of sales, cost of production, material, labor, overheads, this will always have an impact on the gross profit margin rather than on the net profit margin. So C is not going to be the good option. Why? Because here we are talking about the purchases, we are talking about the material, we are talking about the trade discounts. So this will affect the gross profit margin. This will not directly affect the net profit margin. Last, company increased the salaries of administrative staff following the new government guidance on a living wage, which means because of some government regulations, the company has increased the salaries. So if the salaries are increased, which means the company has increased the expenses. And if the expenses are increased, obviously the profit is reduced, and ultimately the operating profit margin is also reduced. So it means the option B and D is going to be the correct answer for this one. Always remember, whenever you are asked to account for the increase or decrease, you just need to play with the numerator and the denominator. That if you want to increase the ratio, so it means the profit will be increasing. So you will find out the reason by which you can increase the amount of profit. Are you guys clear on this one? Okay. Let's move on to the OT case now. That is the final OT case that is related to September, December 2023 exams. And there is a situation given over here. The company manufacture plant and equipment. Its revenue for the year 31st August was analyzed as, that is revenue from the Loho company contract 900, Deping company contract 3000, and Futian company, they have recognized the revenue for $4,000. Now there are three basically contracts. These are the three contracts: contract 1, contract 2, and contract 3, and the details are given over here. Basically, this OT case is exclusively from IFRS 15. That is revenues from customers and construction contracts. So this is basically the construction contract area. Okay. There are three contracts. I think there are four. There are fourth one. That is yet is as well. So there are four contracts. Now let's read out the requirement of the specific question of the specific cases, and then we'll see that which contract it's being targeted. So we'll read the data of that particular contract. Various methods have been proposed by Pingshan Company, that is the name of our company, for measuring the progress of the contract with Loho Company. Okay, so it means we are talking about the Loho Company. So let's read out the data for the Loho Company. That is the contract 1. A large item of plant is being constructed for Loho Company. The plant is controlled by Loho Company and is being constructed directly on its premises. The total contract price is 1.8 million, that is the contract revenue. And at 31st August 2004, the progress was assessed at 50%, which means 50% task is completed. Pingshan Company invoiced Loho Company total of 1 million, that is invoice raised by the company and settled by 31st of August. Pingshan Company incurred recoverable contract cost of 0.1 million, that is the cost to date. And the total estimated or expected cost to be incurred is 1.3 million. So that is something the data is given over here. Now, what is the requirement? That the various methods are proposed. Which method? Various methods are proposed, and these are the four methods that are being proposed by the company: fair value method, input method, output method, and effective interest method. Now, what is the requirement? In accordance with the IFRS 15, which of the above method would be appropriate methods for measuring the progress of the contract? And that is a very easy question, I think. Which of the following? Yes, very good. As per IFRS 15, there are only two methods that is being recommended by the IFRS 15. That is the input and the output method. So there is no difficulty in it. And the answer for this one is 2 and 3. That is option A. Option A is going to be the correct answer for this one. That was very easy question. Now question number 6. Here it says they calculate the contract asset or the liability. Contract asset or the liability related to the Loho Company contract. Okay, the contract that you are studying. So the same with the same contract asset or liability will be calculated. So let's try to calculate the contract asset or liability. Before we move on to calculate the contract asset or liability, first write down the formula for this one. The formula is revenue recognized. Revenue recognized minus amount invoiced. Revenue recognized minus amount invoiced. Now, the total contract revenue, that is contract price, is given over here is 1.8 million is the revenue recognized. Sorry, it's not the revenue recognized, it's the total contract price. So 1.8 million, 1.8 million. 1.8 million is the revenue recognized, and the percentage of completion is 50%. 50%. 1.8 in times 50%, that is 1.5. 1.8 in times 50%, that is 0.9 is the revenue recognized. And the amount invoiced, it's written in the question, that is 1 million. 1 million amount is invoiced, no matter whether it is paid or not, but 1 million is the amount invoiced, which means that you have invoiced the more amount, and you have served lesser. You have invoiced 1 million, but so far the revenue is recognized is 0.9. So 0.1 million is basically the contract liability. It's a contract liability. This amount, if it is in negative, so it will be a contract liability. If it is in positive, so it means it's going to be the contract asset. So the contract liability is 0.1 million. So the contract liability is 0.1 million. That is option B is the correct answer for this one. If it would be a reverse situation, for example, if the revenue recognized is 1 and the amount invoice is 0.9, so then the 0.1 is going to be the contract asset. But so far it's not the case. So the contract liability is 0.1 million. Now let's move on to the next question. That is question number 6. So question number 7. The amount recognized by pension relating to the depping company contract is incorrect. What is the correct total income to be recognized pension company's profit and loss account in respect of the depping company contract? It means now we have to move on towards the depping company. Which one? That is the second paragraph. That is the second contract. It means the revenue that is recognized over here is incorrect. That is 3,000 is the incorrect value. We need to calculate the correct profit related to depping company. Now, how are we going to recognize it? How we are going to recognize it? First of all, let's try to read out the data. Equipment was sold to depping company on 1st March 2004. The equipment was sold on 1st March 2004 and allowing the depping company the credit term for 1 year interest free. The significant benefit for the depping company, it means the amount will be paid after 1 year and there will be no extra amount. Interest free means there will be no additional amount. And the cost of capital, the interest rate is 7%. Pingshan company recognized the full amount of 3 million. As we can see that the full amount of 3,000 was recorded as an income, as a revenue. And that will be paid on 1st of March 2005 within the revenue of 31st August 2004, which means that the 3 million amount of revenue is being recognized, and we all know that this 3 million should not be recognized as a revenue. Why? Please remember that whenever there will be a future payment, whenever there will be, whether it's in a liability or it's an asset, whether it's an expense or it's a revenue, whenever there will be future payment, it shall always be recorded at its present value. That is something stated in IFRS 15 as well. So the revenue should have been recognized at its present value. First of all, let me make the accounting timeline for this one. Let me make the accounting timeline for this one, that when the accounting period is ending. Accounting period is ending on 31st of August 2004. So accounting period is ending on 31st of August 2004. So if the accounting period is ending on 31st of August 2004 and the agreement was made on 1st of March 2004. 1st of March 2004, and this amount of agreement, that is 3 million, will be paid after 12 months, that is after 1 year. Now obviously, if there is a future value of 3 million, this will be discounted at its present value. So we are going to calculate the present value for this one. 3 million divided by the interest rate is 7%. So 1.07 power 1. So anyone please calculate the present value for this one. What is going to be the present value for this one? Can anyone please calculate the present value for this one? 2.80. Good. So 2.80. So it means the initial revenue should be recognized at 2.80. At 2.80. Now this will only not be the case. That revenue will be recognized on 1st March 2.80, and whenever the amount is recognized at its present value, it should always be have an unwinding impact. It means from March till August. Let's count it out. March, April, May, June, July, and August. Which means for 6 months, there will be an unwinding. There will be an unwinding. And this unwinding will be recognized as an interest income. So it means that on this particular 2.80 multiply by 7%, multiply by 6 and divided by 12. Can anyone please calculate the value of it? And this will be recognized as finance income or income. 0.098. 0.098. Can anyone please add up both the values? 2.8 plus 0.098, that is 2.89, I guess. Is it? Yes, Adil, it's interest free. And I told you, what does it mean by interest free? Means that you have to pay 3 million. There will be no additional amount that you have to pay. Interest free means there is no interest element. But yes, if the amount is paid after 1 year and the time period is material, it is given, it is written in the question, it is written in the paragraph that the time period is material. So if the time period is material, so which means there is a financing agreement. That is the terminology used by the IFRS 15, that there is a financing arrangement. There is a financing agreement. Although no additional amount will be charged to the customer. Interest free means that you will have to pay 3 million. There you have to pay 3 million. Although you will pay at some later date, so no additional amount will be paid. In this 3 million, there is some interest component. In this 3 million, there is some interest component. IFRS 15 states that if there will be a future payment, there will always be a financing arrangement. It is something that you are giving a loan. Although you're saying that it's interest free, IFRS 15 states that no, it's not interest free. There is some interest in that particular 3 million amount. Are you getting the point, Adi? Okay, now. So the amount is 2.8 million is revenue. 2.8 million is the revenue. 89 million is the revenue. But there is a problem now. There is a problem with that particular question with the exam. The answer is 2.89 million. If we just look at the options that is available to us, there are options and definitely C and D are both incorrect. Now there is a problem. If the answer is 2.89 million, so it seems that it should be marked as 2.8, and if we just round it off, so it would be 2.9. So it means both the options are available over here. Now, this is something my personal opinion is, might be the other instructors or other tutors might not agree with my point, but I think that there is some blunder with the ACCA exam or the examiner, that the most similar options are over here. So it means there should be a gap, but if the examiner, most of the students, what they did, they marked it as 2.8 million, which is incorrect. According to the examiner answer, 2.9 million is the correct answer, which I think is not justified. It's my personal opinion, because the answer is very close, 2.89 million. Most of the students would be marking it as 2.8. Else, the examiner should write it down that the value should be rounded off to the nearest thousand. then yes, the answer should have been 2.9, but it's nothing written, it's not written over here. Nothing is written over here. If the statement would have been written over here that the answer should be rounded off to the nearest thousand, so yes, then the 2.9 million should have been the correct answer. But so far it's not written over here, so definitely the student might make this mistake, or I would not say this is a mistake. The examiner or the student would be marking A or 2.8 million as a correct answer. But nevertheless, the examiner has marked 2.9 million as the correct answer. Are we clear on this one? Yes, this could be done. That is the same point that the student says that when we take 3 digits after decimal, which comes to 2.9 for rounding off. Yes. Yes, Renika, very right. That selling price is basically the amount that you will recover from the customer is 3 million, and in this 3 million, if the present value is, if the present value is 2.80, so it means the remaining amount is for the finance income. We will not call it as finance charge or the finance cost, it's finance income, it's interest income. So out of 3 million, if 2.80 is your sales revenue, so remaining amount is going to be the interest income. Yes, Adil, you are absolutely right that if you round off, but in exams there could be a confusion. If there are two options, that is 2.8 and 2.9, so which option to select? So there might be a confusion, but it's better to round it off to the nearest. That is the best solution, or that could be the best option. Are you clear on this one? Now, another question. There is no significant financing. It means there is no concept of unwinding in this particular question, in this particular requirement. In the contract with Futan company, what is the correct amount of revenue to be recognized in the Bingshan profit and loss in respect of the Futan? Okay, now let's read out the data related to Futan company. And that is the third paragraph. An item of plant with the standalone price of 4 million. It means the plant standalone price is 4 million. Was sold to Futon company on 1st June. Specifically for this contract, the transaction price is 4 million, which means that the price of plant is 4 million and the transaction price is 4 million. That's good. Includes a 1-year service contract at no extra cost, which means the company will be charging 4 million and the price of plant is 4 million, but in addition to that, the company will provide 1-year free service. Futon company, 4 million was invoiced to the Futon company on the date of delivery. The cost of servicing the plant is 0.3 million per year. Pingshan company ordinarily charges markup of 1/3 of servicing of plant. Now, this is something not related to the construction contract. This is something related to the 5-step model, that is to record the revenue by using or by applying the discounts. Now, first of all, identify the performance obligation. We have two performance obligations. Number one, plant, and number one, 1-year service. The standalone price of plant is 4 million. Why the standalone price of the service is not given, but yes, the hint is given over here that the cost of the service is, the cost of the service is 0.3, and the markup is 1/3. The markup is 1/3 and cost is 0.3. The cost of the service is 0.3, And the markup means that is the profit on cost, and that is 1/3. 1/3 means that if you just divide 1 divided by 3, so you will get the answer 33.33. That is, the profit is 33.33% and it's on cost. So cost is 100. So the selling price is going to be 133.3. What do we need? We need the standalone selling price of the service. So how we are going to calculate the standalone selling price? It's 0.3 multiplied by 133.33 divided by 100. So 0.3 multiplied by 133.33 divided by 100. So it's 0.39, we can make it 0.4, right? 0.4. So it means the selling price of the service is 0.4. 0.4, which means the total price of the performance obligation is 4.4, but the transaction price that is being charged to customer is 4 million, which means there is a discount element of 0.4 million. It's a discount element. Now what we have to do, we need to allocate the discount on the basis of standalone selling price, which means that 0.4 multiplied by 4 divided by 4.4. 0.4 multiplied by 0.4 divided by 4.4. So let's see what how much the discount will be allocated to plant. So it's multiplied by 4 divided by 4.4. So it will make 0.36 million. And 0.4 multiplied by 0.4 divided by 4.4. So it's 0.03 million. Or you can make it 0.04. That is 0.04. So 0.36 plus 0.04, this will make a total discount of 0.4 million. So now the discounted price, that is 4 minus 0.36, this will make 3.64, and 4 minus 0.36, 3.64, and then 0.4 minus 0.04, decimal 04 is 0.36. Now the total amount, if you just want to calculate, is 3.64. This will make 4 million. That is reconciled. Now, what is the requirement that what amount of revenue should be recognized? Correct amount of revenue should be recognized at the end of the year 31st August. Again, this contract was made on 1st of June. Yes, this contract was made on 1st of June. If it was made on 1st of June and the accounting period is ending on 31st of August, which means 1st June. So what we are going to do, first of all, we are going to recognize this revenue 3.64 in point in time. That is at the time when the transaction is executed. So this will be recognized as a revenue. There is no question in that one. But this 0.36 is for 12 months. So from June, July, and August, which means this will be recognized for a period of 3 months. That is 0.36 multiplied by 3 and divided by 12. That will make 0.09. 0.09. So ultimately the total revenue that will be recognized is 3.64 plus 0.09, 3. So the total amount is going to be 3.73 million. So the total revenue that should be recognized at the end of the year is 3.73 million. 3.73 million. So the correct answer is 3.73 million. That is option A. Are we clear on this one? So this was the question that was related to IFRS 15 5-step model. Now the last question that is related to Yantian contract. Yantian contract, let's read the requirement. Let's read the data for the Yantian contract, that what is the requirement, what is the data of this question. That is last one. On 1st September, the next financial period, Fengshan are combining two items of equipment into one single package. It means two equipments. There are two equipments and these will be combined as one, that is, it will be sold as a package, which is currently the only customer for these two items. The package will be sold at a discount when compared, which means collectively once it will be sold at a discounted price to the sum of the standalone selling prices to the individual item, and the individual item of the equipment will no longer be sold. Servicing is not included. There is no services. Only two equipment will be sold as a combined item. Now let's see that what is the requirement. What is the requirement for this one? For the Yantian company combining two items of the equipment but no servicing contract, which of the following describes the correct accounting treatment? It means now the equipment 1 and 2 will be sold collectively. Apply the discount to the equipment with the highest value. It means the discount will be allocated to the highest value. Is this the situation? Whether we allocate the discount in that particular way, that we allocate the discount to the highest standalone selling price. Very good. We allocate the discount on a proportionate basis on the basis of the standalone selling price. Very good. Excellent, everyone. So option A is not the correct option. Apply the discount to the equipment with the lowest. No, this is not the option. Allocate the discount proportionately to both the equipment. Yes. And again, if I just complete this sentence, on the basis of stand-alone selling price. On the basis of stand-alone, as we did in the previous requirement. On the basis of stand-alone selling price. Last one, let's read out the last one as well. Recognize the revenue as the sum of standalone selling price with the discount allowed, recognizing the separate as an expense. No, discount allowed or the discount will be adjusted in the price of that particular standalone selling price. So option C is the correct answer. Option C is the correct answer. Are we clear on this one? So these were the difficult questions that were stated by the examiner, that these are the most difficult questions, and we had an analysis on these questions. We solved all these questions. There are other attempts as well. And what I've done, I have compiled the most difficult questions at one place. If any one of you is interested on those particular questions, I can send you the file of those questions that is related to examiner reports the most difficult questions that were tested in previous attempts, in the previous last 6 attempts. So I can definitely send you the compiled PDF file of those along with the answers as well, obviously, of course. So you can just note down my WhatsApp number. You can just WhatsApp me and I'll be providing you with the content. You can definitely WhatsApp me and I can provide you with the content and other content as well. I wish you all the best. I hope that that session was quite useful for you everyone, and you must have learned something from that particular webinar, from this session. And if you have any feedback, any sort of feedback related to that particular webinar, or you want these sort of webinars in future, so please do let me know. Do inbox me your feedback, and you can just WhatsApp me. I'm just a message away. So thank you so much for joining this session, and I pray and I wish you all a best of luck for your upcoming exams. Feel free to contact me if you have any query or question. Thank you so much for joining this session. Allah Hafiz. Goodbye. Pranika, you can WhatsApp me your query, okay? You can just WhatsApp me your query. I will answer you. Don't worry.